2022 was the worst year for the S&P 500 since 2008, when the broad market index fell 19.4%. Although no one likes to see their portfolio fall, seasoned investors know that bear markets offer good buying opportunities. In fact, declines are good for stock buyers because they make stocks cheaper. There are plenty of bargains available in the market right now, and if you're looking for bargain buys, there's no better place to start than the worst performing stocks in the S&P 500 index over the past year. All the stocks mentioned in this video have lost about 70% of their value, and you might be surprised at who made the list. Number 1. Tesla. Tesla has been a highly touted stock for years, and after booming during the pandemic, the electric car leader gave up most of those gains last year. Although its overall financial results were solid, concerns about production growth and sharpening competition weighed on Tesla stock. But the biggest reason for Tesla's decline in 2022 may have been CEO Elon Musk's decision to acquire Twitter. This has made Musk a lightning rod for political controversy, and many investors believe that this distraction is taking his focus away from running Tesla. Tesla's brand reputation may have deteriorated in the past few months, and there is a risk that these headwinds could persist. The good news is that the stock is now trading at a reasonable price, with a price-to-earnings ratio of just around 40. While Tesla remains a high-risk investment, if it can reach expected production levels and maintain its lead over its electric vehicle competitors, it could recover some of its losses from last year. Number 2. Align Technology. Align Technology, a manufacturer of dental braces, was also a big loser last year. The company faced a difficult comparison to 2021, which saw a spike in sales due to the pandemic effect, where customers returned to dental offices after avoiding them during a pandemic. Sales not only fell 12.4% in the third quarter of 2022, but also fell quarter-on-quarter, showing that the company is facing recessionary pressures. Its Invisalign dental braces are an expensive discretionary product, and consumers may delay purchasing these products due to fears of inflation and a potential recession. With the company's growth story on hold for the time being, investors will probably be better off avoiding the stock until its growth is back on track. Number 3. Generac Holdings. Generac Holdings, a manufacturer of generators, was one of a number of stocks that boomed during the pandemic but have fallen significantly in the past year. The stock surged in 2021 as rising household operating expenses and power outages in Texas led to a surge in demand for generators, but sales growth slowed in 2022. Then in October, the stock also plunged after a major customer declared bankruptcy and the company cut its outlook for this year. Going into 2023, the consensus on Wall Street is that pandemics and mass outages have caused a drag on generator demand, and analysts are forecasting an industry-wide revenue decline in 2023. The expansion of two-way electric vehicle (EV) charging also poses a threat to the market for home backup power or backup generators. Given these headwinds, Generac Holdings stock deserves a cautious approach in 2023, although it trades at a reasonable price-to-earnings ratio of 17. Number 4. Match Group. It may surprise you to find Match Group on this list, but like Generac Holdings, Match Group experienced a boom during the pandemic before the stock gave up those gains as revenue growth slowed. In the third quarter of 2022, the company's revenue grew just 1%, or 10% in currency-neutral terms, and operating profit was unchanged, though the stronger dollar likely played a role in that slowdown. The change in Tinder's management has also led to a slowdown in the growth of the company's core application. However, currency-neutral revenue still grew 16%. In addition, newer products such as Hinge continue to thrive, allowing Match Group to continue to dominate the dating market. Match is still a growth stock that has the potential for a large addressable market. If growth starts to accelerate again, the stock could take off.